All right, folks, we're going to go ahead and get started today. I'm glad you all could join us for today's market update webinar. We're so fortunate to have Case and Brian here with us from, well, Case, you guys used to be, and Brian used to be known as Brinker Capital. I guess it's Orion Advisors now.
Both.
It's still Brinker Capital and Orion Wealth. We're still
all right.
Under one umbrella.
Oh, no, but you guys are always so gracious to take time out of your busy schedules in order to help us just kind of cut through what I refer to as static. There's probably more colorful names that you could call it, but just get clarity around really what's going on, what is real rather than what's the news media's portrayal of what's going on. So it's always appreciated that you guys take the time to join us. So thank you.
Happy to be here.
Absolutely. Thank you for the opportunity.
So I think, Case, the way we always start these off is tell us kind of what's been happening with markets and driving markets as of late. And I guess segue from that, where are we now?
Yeah, absolutely. Mark, I might actually share a few slides if that's okay, and have
go for it.
Have a few just images up here. And I think it's always nice to just look at some pictures along as we get this started. So what's really moving markets today? We've seen quite a drastic jump in stock prices since the low of October of last year, right? It was a tremendous Q4. It was a great Q1. Q2 is shaping up very well. And right now you'll see in the stock market news that we are in quote unquote a new bull market here for S&P 500 type companies. So there's a lot of reasons why we believe that we are finding new highs here, and that the October lows, if you will, of last year are firmly in place, and we will not revisit those. A lot of it has to do with inflation coming down drastically. It's falling just as fast as it went up last year. You have also the Federal Reserve seeking to put an end to their interest rate hikes. And in the June meeting, they actually paused. We do expect one more hike for later this year. We can kind of dive deeper in that maybe later, but you have that. And then you also have corporate earnings, which honestly are shaping up pretty well. And then come back to it, Mark, you talk a lot about a static. We call it noise, right? Usually there's a lot of noise in headlines. There's a lot of noise in the news, but stock prices follow company earnings. And typically they will bottom before company earnings will, and company earnings will bottom before the economy does. So we have a lot of good things happening here. But I will make mention just in this next slide and share this chart with you that so far year to date, it's really just been 7 select companies moving our markets. So that is not necessarily a great thing. Obviously, we like the positive price returns, but when you're only dependent on 7 out of 500 companies, that is something we'd like to see better, what we call breadth, where all the other companies are, approaching their all-time highs too. They're approaching bull markets. So we need to see that turn around. And quite honestly, here as we're recording this towards the end of June, we are seeing better breadth for the month of June, which is a welcome sign, meaning that value stocks are starting to participate, banks and energy companies. And you're also seeing some small cap stocks start to participate too. So it's really not just the largest 7 companies, which in our index here in the United States tends to be only one area of the market, which is growth stocks. So for diversified investors, like we always are, like your clients believe in, and everybody listening believes in, it'll be good to see these kind of bottom half of the market cap start to pick up steam in the second half of the year. And that's really what we expect.
Well, with regard to these 7 companies, Congress is mad at them right now. Depending on who you are as a consumer, you might be mad at them. now right. The financial world getting mad at them. Who likes them?
Yeah, exactly. That's very true, and they are getting sometimes too big to fail, if you will, to use a banking term.
Sure.
That's correct. Because I remember when we Apple hit like $1 trillion in market cap not too long ago, right? Now they've added $1 trillion in the last couple of weeks, and it's just amazing the compounding you can get from some of these companies growing bigger. So we to do that point to that point, Mark, when you get so big, you really, the old saying is trees can't grow to the sky, right? You end up seeing potentially less growth. So, and that is true. We've seen various studies where actually once you start to get to the biggest companies in the world, it's not going to keep compounding your growth rate at the same time. So that's why we like to remain diversified, because we are always in search of those up and coming companies, right? That we probably haven't heard of yet. But they will be the next Tesla. They will be the next Amazon in 15, 20 years.
Well, I think that's a great point, Case. And I'm glad that you kind of like highlighted this fact. I mean, these 7 companies, the behemoths, if you will, the tech world, they've pretty much been driving the S&P for some time now.
Yeah.
And your comment on why portfolios need to maintain diversification is an important one, because it gets you exposure to those companies that, as these guys continue to stay behemoths, their growth is likely going to diminish. And so you want the exposure to these other companies. I'm so glad that you pointed that out. Absolutely. So is it a fair assessment to say year to date, maybe what's been driving markets so far is an improving outlook? It should maybe condense what you said on profitability for corporate America, an improving outlook that the Federal Reserve isn't going to just kill the economy by interest rate hikes.
Yeah.
And then the last one, that maybe consumer spending by proxy of corporate earnings continues to show strength.
Yeah, and that's, I think, the last point you hit on the head, because I'm going to fast forward maybe just a couple slides here, but we always look at this in terms of our barometer, and let's just jump down to kind of that behavioral point, and don't be so worried about what the bullet points say, but let's just kind of look at where we're at in our stock market barometer. Consumer is a lot of behavior, right? And the consumer makes up close to 70% of our GDP. So right now, in the news headlines, and there's no shortage of them that are saying, recession. They probably backed away from that a little bit lately, but I think they fail to appreciate how much the consumer is a part of our economy right now. A lot of these metrics that the government likes to use, or other agencies like to use, they try to predict recessions, or they look at leading economic indicators, right? But they place a lot of emphasis maybe on areas that just aren't our economy right now. And a lot of that is manufacturing, right? You go back to World War I, World War II, we were a big manufacturing country. And that's where a lot of our GDP came, how much we produced. But you fast forward to, the latest 30 years, where the consumer story really started to take off here in the United States. And at the end of the day, Mark, you're exactly right. That's what drives our GDP forward. That's what drives spending forward. I mean, there's a lot of stats, that we look at, of course, that the consumer is still in really good shape coming out of COVID. We still have rising incomes. Wage growth for the bottom percentile of earners is actually increasing the fastest. That's just good for America, and it's really good for our stock prices. And again, I kind of come back to this point a lot of times, but the consumer stays strong, and you don't see, people get unemployed or lose their jobs. I think we can engineer what the Federal Reserve likes to call the soft landing, where you bring inflation down to check, and you get still positive GDP growth, and not a significant rise in unemployment. So we will have to see, as we point out in this barometer, there are, of course, some stats and areas that are leaning negative. But for the better part of this, what you mentioned there, Mark, is still very positive. Consumer behavior is good. Corporate earnings are on the uptrend again. So and the stock market at the end of the day kind of sniffs all that out before the rest of us really can, because it's a combination of everybody's thoughts out there, and it does a pretty good job of anticipating that, because it did a really good job of anticipating it last year, right? Because you saw the NASDAQ down 35%, you saw S&P 500 down 25, but now we're moving on from that, we believe.
Yeah, maybe Case, to your point on consumers and whatnot, maybe the one thing that we have to thank Silicon Valley Bank for is making the Fed flinch.
Yeah, that's a really good point. That's a really good point.
So
I'd love to kind of dive deeper on that if you'd like. Real quick, right? Because
it probably worth touching on, because I mean it's still a question I get a lot from clients is, hey, with the banking issues that we had, I mean, how are things?
Right. Yeah. And I have a couple just slides on that. So, pardon my moving back and forth, but I think because, this is a great conversation we're having. So, really what we say is the banking crisis overblown, or was it past us? Yes and no. Yes, we believe the Fed did the right thing by setting up liquidity, and the Treasury Secretary Janet Yellen did the right thing of basically backstopping these depositors of these banks that failed. Don't get me wrong, this is not like a moral hazard issue like we had in 2008. If you're a shareholder in those companies, which you saw the articles, a lot of people were, they went to zero. So if you're a shareholder, you were hurt. But just normal folks like you and I and Brian and everybody else on the call, if we were just having our money there as a bank that we trust, there should be no issue to get your money out. And that was the right thing to do. So they stepped in very quickly. You saw a lot of just confidence restored back in the system. But what it did, Mark, what you're saying is basically, as we show here in the chart, acted as a de facto rate increase when this bank failed. Because what does that do? It's everybody on watch. Everybody, meaning small regional banks that are the lifeblood of your community, of my community, they're probably less likely to lend at the rate that they were, right? They are more or less in a little bit of worrisome that their deposits may flee. And, that could cause maybe a bank run, essentially what happened to Silicon Valley. So the fact that these banks failed, the Fed really changed their language in their meetings and said, this is something we need to watch. We don't maybe need to be so hawkish because the situation's changed, right? So, as you see over here on the right, it just, as this chart moves up, it just means lending standards are getting tighter. They were already getting tight as a result of the Fed raising rates, but now we just believe that they should continue to get tighter there after Silicon Valley failed. And honestly, the market still rallied past those bank failing issues. There's a little bit of volatility first, but everybody kind of piled into those larger company tech names that we mentioned at the beginning of this webinar. And I think they kind of shunned some of these smaller companies, but really you still see some opportunities in those smaller companies, we believe, for the rest of the year.
For sure. Yeah. And I think, maybe piggybacking off what you just said, and maybe adding just one thing to it, Case, the real issue that I see, and again, part of what the Fed was trying to engineer by their rate hikes was I would say tightening, credit standards, but limiting growth, right? And so Silicon Valley Bank, if there's higher rates, it has that de facto, in your words, effect of slowing down growth because lending standards tighten, and so money's not as abundant, et cetera. So anyways, now that, we kind of maybe beat a dead horse on kind of where we are now and what's been driving markets to start the year, what are y'all anticipating? And again, there's no guarantee of anything, right? But what are you guys seeing as far as the rest of the year, and kind of what should expectations be?
Yeah, I think I'll jump back to this slide, and we still see positive returns for the rest of the year for expectations. I think, we get this question from time to time that says, the average return for stocks let's just say it's 10%, right? It goes back and forth, 8 to 10, whatever it may be. So you get a lot of clients kind of just looking at that and say, gosh, Mark, I got 10% this year. Should I just kind of cash my chips in and say, let's wait till the next year? That is a warranted question, because there always is worry that I may lose what I just gained, right? And that's a real thing. However, we do know that stocks can continue to move higher. They don't necessarily care about the calendar year, right? Maybe just a little bit, but they really don't. They'll move forward regardless what calendar year it is. It just so happened this calendar year has been off to a great start, and last calendar year wasn't. But yeah, we still believe much higher returns are ahead of us. Again, we're over 10% here in most common stock markets that we're talking about. And you just see some of these years we picked out where you saw really good Q1, Q2 returns. The rest of the year ended up being still very positive. So the numbers are always in our favor there for the outlook of the stocks to return positive. And, I think this chart just kind of shows you not to get too worrisome, that there still can be more gains on the table for you. Always keep your risk tolerance in check, but just know that the stock market is probably, again, just starting a bull market. So you really want to be in those good times, and you've seen a lot of good times so far this year.
I like to tell clients a lot as well that they all see the grocery prices going up and things of that nature. They know inflation is here. They see housing prices. But just remember that in times of inflation, historically, stocks are still considered real assets.
Mm-hmm.
And those stocks typically do well or better than many things in an inflationary environment. So Coca-Cola is not going to stop selling Cokes. Those kinds of companies are all in the business of making revenues for their stockholders. And as Kay said, those revenues are what really drive the market overall.
Yeah. I mean, that is 100% true, especially when inflation is falling, right? We've already hit peak inflation. So you just got a lot of tailwinds this year, guys. I mean, you think about it, and I'm probably going to sound like a dead horse because we keep beating that dead horse, but inflation falling, the Federal Reserve slowing down and probably done after one more hike. That is an outlook, right? Probably one more interest rate hike in July. And that's really where you see the rest of the year going, we believe. There still are some obviously headwinds against us, but there's more tailwinds. The one last thing I'll note as far as just like stock market outlook is, this is always a fun one, but it's the third year of a presidential campaign, right? I'm sure we're all really excited for next year for those ads to ramp up. But the third year of a campaign, we've crunched the numbers, and I don't have the data here in front of me, but the third year is the best year. Now that could be something to do with, there's always a lot of campaigning in preparation for it, very economic friendly regimes. Obviously you don't want to go into a recession right now if you're trying to get reelected next year. And this is regardless of your political affiliation, it does not really matter. It's just to look at the third year is always the best. And what's the worst? It's the second year, which was last year. So it actually hit it pretty well so far on the head, that last year was a weak year for a lot of reasons. But also this year has been so good. So again, we think stocks can have much higher room to run. As far as like the economy goes, as an outlook there, Mark, I would say recession is pushed further down the road. Again, there are some, weird things going on with the economy, with short-term bonds yielding more than long-term bonds, which usually doesn't happen, right? That's not typically pro for growth. But just the fact that the consumer still remains very good, and there's record number of jobs being created every single month, it's very encouraging for us. And the last thing I'll say on that is housing, because I think, Brian, you mentioned it. Prices have been coming back up again. They were basically at an all-time high for COVID reasons and for people having a lot of disposable income. And then they kind of took a pause here recently, which honestly it was really good for inflation numbers. But we do see housing starting to pick back up again. And that is a big part of our economy too. Just last month, there was a record number of permits being issued for people to start, building houses again. So people are actually looking past this perceived notion of a recession coming and saying, you know what, there's still a lot of demand out there. I got to start producing houses because I don't want to miss on it. And that, again, comes down to what Brian mentioned is, we're in the land of the best CEOs in the world, and they're going to find out a way to make money and really work for the consumer.
Well, I love the comments both of you guys had. Maybe one thing worth noting, and I'm going to do something I say I'm never going to do, which is use a technical term, but I'll break it down into layman's terms. So, Case, Brian, y'all correct me if I'm wrong here. But the concept known as risk premium, right, or liquidity premium, or any of the other premiums that investors demand to get. Let's just focus on risk. The risk premium is in addition to inflation, which is part of the risk-free rate of return.
Right.
And so, if let's say inflation remains elevated for some time, a big question that I tend to get is, well, does that mean I'm going to run out of money? Well, not necessarily indicative of one versus leading to the other per se, but if inflation stays at 4%, then the risk premium on top of that means stock returns should be far better than 4%, which means you're still making money in real terms, taking into account inflation. So,
absolutely correct.
That risk premium, which is, again, in layman's terms, what we all expect as individual investors to get compensated for by taking risk, has been pretty constant over time. It's sure ebbed and flowed, but Case.
Yeah, it's always there. And there are going to be some intervals, right, where after inflation, there's maybe some deep losses, like last year, where we saw stocks fall, and then after inflation, technically they would have fell further, right? But so far, we're getting past that this year as inflation gets down to 4%. So, and this is true. I've seen various studies, and we've done them too. You go back to the 70s, which I hate to admit, my age, but I was not around as an investor then. But yeah, you go back to the 70s, but we all have history books. So you go back to the 70s and the early 80s, which was when I was born. And you see that still inflation was really high, but there were a lot of times where stocks were outpacing inflation still. So, that is a very good question, because it's a real fear. And when we look at some of the investors' biggest fears out there, inflation is still number one of them. Recession is number two. So, I would just say, don't be surprised for the other side of the coin to happen, right? I think we kind of get worried because we've amassed a nice nest egg, and you don't want to see it go away, but you don't want to be so protective of it that you miss out on future gains. And the fact that we expect inflation to be under 4%, closer to 3% here when the numbers get released. So you're getting back to, quote unquote, that target of where the Federal Reserve wants it to be, which is 2%. We think they'd be happy at 3%. So, they understand that inflation is falling, and they can stop raising rates, which, in the short term can hurt corporate profits. It helps our bank accounts, right? But so there are some people saying I should just own cash right now instead of stocks. Again, that is a warranted question also. Mark, you probably get that one where my cash gets 5% now. Should I pull my stocks out? No, because, maybe for a part of it, depending on your individual needs, of course, but the fact that you can see stock returns, 2-3% in a week, where you get that.
We just saw that.
Yeah. You get that cash return in a whole year. So you can just, and then the joys of compounding really works for you. So that is it's a warranted question, but like we've all mentioned, inflation is coming down, and we'll get back to that normal level at some point.
Yeah, for sure. Well, I guess maybe as we try to finish up our time here in the next several minutes.
Yeah.
Are there any specific like singular issues? I mean, we've hit on inflation, right? We've hit on, housing and a few others. Are there any other singular issues that, I mean, clients need to be really like focused on that could impact markets over the balance of the year, Case?
Yeah, there are some things to stay focused on. I think, and at the end, I got some good slides on stuff you probably should also just keep in mind. So let me just kind of jump into this slide of this this is probably something that you may not hear a lot about, which is why we believe it's maybe a concern, but CRE, commercial real estate. And I don't want to get too deep in the weeds on this, but this is something I'm hearing more, Mark, and you're probably hearing it more too in your local communities, where you just see a lot of for lease signs out there. You see a lot of people kind of questioning, if I own a bond that invests in commercial real estate, is it going to go belly up kind of thing? So, and the word real estate still echoes back to 2008, right? When we had the housing crisis. So it is, I think, just something that people always hear the word and they're always like, gosh, is it a big issue? You'll probably hear more about it. But we just wanted to put these slides together to show that it's not that big of a part of what loans are made up of. So, right, a bank loans money to the office supplier to create an office, and then the office supplier says nobody's coming in. What do we do? But just know that over here on this chart, we're showing that most real estate loans are a very small part of the overall book of business for a bank or who's ever lending the money. So again, not as big as housing, residential real estate. And if you go one step further than that, Mark, you look at kind of that orangish slice of this pie. That's office. That's the one to be concerned about. But the real estate market is so diversified, and you probably see it in your communities where everybody's building apartments, right? So there's still big demand out there for housing. And you got some really, I think retail is starting to come back. You're starting to see a lot of people get more interested in retail. There's a lot of, merchandising brands that are starting to go back into brick and mortar instead of online. So commercial real estate, I think, would be something to be mindful of, but don't be too worried on the headlines. Because at the end of the day, to kind of, skip ahead a couple slides here, the market is not the economy and the economy is not the market. So again, we just know that I'm showing a few slides here of various scary headlines, right? Where you may see, housing crisis or recession, but the market has already maybe priced that in last year and is starting to move ahead. So just don't get too enamored with the headlines, because the market does a pretty good job of moving past that, once the companies can figure out how to make earnings again.
Well, one specific question, Case, and I think this has more to do, maybe two questions on this. I just thought of the second one.
Yeah.
How do the geopolitical tensions with China really play out as far as the markets go?
Right. And their geopolitical risk is number 3 on our list of client concerns, right? First was inflation. Second was the Fed. I think geopolitical risk was third. It's come down from last year, but there is still the China tensions. We used to have a trade war going on, obviously, it's hard to say. I think China, we don't agree with how they run their numbers necessarily for their economy. We don't agree with what they do with their stock market, right? Sometimes they'll just come out and say that this sector of their economy should not be making money. It should not be for profit. And then, you just see drastic write-downs of those stocks. So there's a lot of things we differ on, but and also cybersecurity, that's always a threat as well. But as investors, there is still good opportunity in that China growth story. Whether you believe those GDP numbers or not, that's where a lot of big tech companies, they get a lot of earnings from China, and and they outsource to China. So it is going to still be, it's probably for the next 10 years, something to be a headline aware of, but they're not going anywhere as an economy. And we still believe that there are going to be some pockets there that are worth to invest in. Never your full lot of stocks, but probably just a little bit of it.
And when you look at the overall picture, I think we have to realize that, at least for now, China is just as dependent upon the U.S. as the U.S. is on China.
Mm-hmm.
So no one wants to see some sort of disruption in the flow of goods and services right now.
Yeah.
Right.
Be equally detrimental, if not more detrimental to China than as it would to the United States.
Yeah. And the other thing, real quick, I think part of this has resurfaced lately, Mark and Brian and everybody on the call, is the currencies, right? You've seen China come out and want to maybe devalue the dollar or try to partner with Russia to price oil in the Chinese currency. It's just not going to happen anytime soon. We are the reserve, we as the America, we are the reserve currency for a reason, because we're the most stable economy and we run things the right way. Therefore, the rest of the world trusts us with our dollar the most. The dollar, should not be completely always up and to the right. Sometimes you're going to see it come down against other currencies. But honestly, that's not a bad thing. Again, I'll go back to that point where the S&P 500, our biggest conglomerates, again, they don't just sell here to the US, right? They sell everywhere in the world. And the fact that maybe our dollar comes down a little bit just means that they can export their goods for less money. It makes it much more attractive for people in Europe to buy our goods because they don't have to pay that currency difference. So there's two things going on there. Again, the US economy and the dollar as the reserve currency is not going anywhere. But actually, it could come down a little because it's just been so expensive. And I think that was one of the reasons you saw the stock market fall a little bit last year, is because the dollar was so strong. It sounds counterintuitive, but that it does affect company earnings at the end of the day.
Well, I'm going to get to client questions here in just a sec. And if you haven't done so, go ahead and load those in. But on that same note, Case, you actually beat me to the point on the dollar issue. I was going to ask, as the other issue, the digital dollar that the Fed's working on. What ramifications does that have? Because I've had clients asking about, does that mean that, our money is worthless? Does that mean inflation runs away? Can you maybe provide some thoughts around like the digital dollar? Is it going to happen? What are the implications, et cetera?
I think it has to be explored. That was a big topic. It still remains a big topic, right? But you probably heard more about it when the cryptocurrencies were running rampant, and meaning that they were gaining a lot of traction. They were working their way into our market plumbing more, right? So cryptocurrencies has become somewhat mainstream, but that is not necessarily a currency. It's a speculative asset, right? So, but it still is at least forced the Fed and our banks to try to think of ways to become more digital payments or a digital dollar. Now, I don't think it's at any point anytime soon that would happen, but it does probably need to be explored. One of the reasons that cryptocurrencies are attractive is the underlying technology of the blockchain, which is just a very verified ledger between buyers and sellers, right? It's like instantaneous. The reason why I say this is because let's just think you're buying a house or you're buying a car, or something more simple than that. There's a lot of moving parts in that, right? There's a lot of banks involved. There's a lot of title companies involved. There's a lot of people that just kind of hold up money for a long time, escrow companies. But if you have something more digital, more, very much more verified at the source, you can move money around quicker. And I think that just makes for a better consumer experience. So I don't think it would make inflation run away. If anything, like government spending, does that. And at this point, we're not doing much anymore government spending for that. So, but the history books will write that at that point, and we'll have to pay attention to it.